I mentioned in the last video I wanted to do a trade review of Amba. I wasn't particularly happy with it. I've been through it. It's actually probably a little bit harsh on myself there. But there's a number of lessons, but it still sort of fits the sort of theme that I've identified is the analysis is pretty good, followed up by less than pretty good trades, been sort of fear-based trades thrown in there. So this first section on the spreadsheet is the actual trades that I did. So let's just go through those. Amberella was in the sort of big long base, had this huge Bible gap up BGU early September last year. I bought the stock second day. So that was actually pretty good buying. I'm going to just readdress that shortly, but I'm pretty happy with that. I did another follow-up buy here on the 22nd. As sort of breaking out to properly or to all-time highs. Now I'm not sure that was that good. It looked a bit sort of like I was sort of chasing an extended stock there. Anyway, that was not too bad. Now then I've sort of proceeded to do some sort of funny trades. At the beginning of October, I actually sold and then rebought pretty much straight away. Now, I can't exactly remember why I did that, but looking back, the market was looking really quite shaky then. This has been pulling back. So what I was doing is basically just getting nervous. So again, analysis is pretty good. This stock's coming out of a long base, up on huge earnings, and then it gets a little bit of a wobble, but doing nothing particularly wrong in a bad market, and I decide to sell and buy back. So that's definitely a cross. Further on the 20th of October, so it was around about here, stocks sort of pushing out really nicely. I actually did a switch, so I sold the shares and bought options instead. That was probably a little bit neither here nor there. But the good thing about that was just taking like a dollar risk off the table. So instead of having $173 a share for each share, I could spend $10 on an option. You can see here that was a $240 call, so it's sort of pretty far out of the money. So it's definitely not like for like, but my overall net exposure was reduced doing that. I'm going to come back to sort of shares versus options in a tick. Okay, the next time I sold some more of the remaining shares was here. That's actually pretty good. Had this sort of very unsustainable rally here, had a sort of big sell-off sort of distribution day. So that was starting to show you that things were starting to look a bit shaky. So I sold a bit more here, and also was sort of coming up to earnings. So that was a good decision. Okay, well, the next time was 19th of November, so that was here. Getting nervous, but equally that's coming up to earnings, so I don't think that was actually too bad a decision there. You can just see here, it's just like a lot of little trades, just a little bit erratic, but overall sort of not too bad in this case. Anyway, on the 2nd of December, the stock came out with huge numbers, earnings per share, tried to rally, actually failed. That was a discuss. I probably should have just sold the whole lot then because the market was getting tired. The stock just can't keep pushing after sort of huge news like that. You know, what can? Anyway, at that time, I actually sold those options that I bought back here. Cashed out and bought more further out of the money again. So same strategy, just taking dollar risk off the table. And then the remaining trade was 20th of December, and that's what I sort of said in my last video. I sort of just a bit ticked with myself. So that was 20th of December here. Now, forget what's happened since. Let's look at what's happening now. I was starting to think this is looking more like a stage 3 rather than a stage 2 sort of nice uptrend. Whereas I was thinking of stage 3, had this, I think that was like a minus 18% day or some huge drop there. You can see it's just getting really wild, really erratic, volume all over the place. So that's usually more of a stage 3 top coming in. So while I sort of tickling myself, I don't really like to sell into weakness. So it was sort of, even though in hindsight it's proven to be a good decision, at the time there was a little bit of nervousness there. Again, probably just being a bit harsh on myself. So overall, the actual trade was actually pretty good. Now I just want to go through and just diagnose how that might have been done better, which is this following table here. So, okay, I'm going to break it down into two different trades. If I'd taken action when I initially took actions at that BGU level here, which is just these two tables here, and then the second one is if I'd waited for the market to flush out on the 5th of October, that's when the market gave me a signal to buy. What would that have looked like then? So in hindsight, I probably wouldn't buy at this BGU level, given that the market was in an amber or red phase. It was very much sort of a topping process. I would have actually waited to the market had a flush, even though I was paying a bit more for amberella. But that was actually a very good sign during this, when the market was going down. This stock was actually holding its ground really well. But anyway, if I just bought stock and sort of didn't sort of faff around buying and selling so much and switching into options, but just bought stock at this BGU level based on a 15% allocation and taking a 7% stop loss, so that would have caused me to take a 1% loss on the portfolio, which is the same as what I'm taking the option positions in. I would have sold like I had done previously, sort of here after that sort of first shakeout going into earnings. So sold half at 193 and then sold the other half at 201 here after the earnings, but just couldn't push on. So that would have given me a sort of hypothetical $100,000 portfolio, an overall 6.6% contribution to the portfolio. The trade that I actually did was closer to 4%. So that would have meant holding my nerves a lot more, keeping things simpler. I don't think actually in hindsight, even though this is, you can see, that's the optimal one, I probably wouldn't take it because the market just wasn't ready here. But anyway, it does go to show the power of these stocks that break out huge on huge volume, which is actually cut off there, pulling out a long-term basis. They can be just as monstrous winners. Anyway, instead of buying stock, if I bought options, now I'm using a 1% exposure. In this case, a 6-month option, $200 calls, so that's roughly 50% out of the money, and a 56% implied volatility. The actual return wouldn't have been that good. The portfolio would have increased by 2.5%. Now, the lesson there is the implied volatility at that point was actually quite high. So tend to find when that implied volatility gets to a certain point, it actually just becomes easier or cheaper to buy the stock. So as a sort of rough rule of thumb, sort of less than 40% implied vol would have yielded sort of a similar-ish sort of result to just buying the stock. Whereas in this case, the implied vol was really quite high. Yeah, that's a bit easier said than done too, because the good thing about an option is that there's a definite floor. When you buy a stock with a stop loss, you think you've got a stop loss, but sometimes you can just blow straight past that. So anyway, if I'd only done the trade when the market had also given me the signal, which was this point here, let's look at those figures. So if I just bought stock only, working through, I would have bought $150. Same exit as before, overall contribution of 4.6%. If I did the same trade with options. Options would have cost me $10. Would have sold at 26. I actually would have held through earnings. The options through earnings again because the exposure is actually not too big. You can afford to sort of just run the risk. Again, like the actual return wouldn't have been sort of that good at all. The percentage return looks good, but if the percentage exposure in your portfolio is not that big, it actually doesn't make a huge difference. The last one is the one that sort of similar to what I would have to what I actually did do, and this allows me sort of to have, I think, get plenty of exposure going into earnings without taking too much risk. So if I bought here when the market had bottomed out, the implied vol was too expensive. So let's just say I bought the stock, had a stop loss in, and actually sold the stock here, like where I did the partial sales previously, but instead reinvested some of the profits back into options at that point. So the good thing about the options is my dollar exposure is quite low. So going into earnings, if the earnings is terrible, I'm not going to do too much damage to myself, but I also get a lot more exposure as well. Now, for the sake of this example, I've actually assumed I made no money on that subsequent option trade. I would have made a few bucks, but assuming that was nothing, I still end up with sort of a pretty decent result. So it's not the same as sort of going back in the original BGU level, but this is I think a far safer trade to make. And who knows, this story could have ended up being quite different here. If the stock sort of blew up to $250 plus with plenty of option exposure there, I could have made a small fortune out of that. So, okay, so that's how I sort of think I'll handle that one in future. And you can see here that stage 3 sort of thought actually worked out to be pretty much bang on. The market's just been terrible. This thing's been hammered. It's probably getting closer to a sort of stage 4 as it's broken down past these previous lows here. So yeah, no, definitely glad to be out of that one. So in summary, I've got some notes here. You can see some scared trading there in my actual trades that I did. Not very well sort of thought out, which actually led to a bit of over trading. If you're holding options and the stock really starts to get volatile in that stage 3 movement, you can actually get a bit lucky because the volatility will pick up. So you find the option prices sort of pound dollar for dollar will actually just pick up a little bit. So that actually just can get you out of jail sort of free sometimes. Now you've just got to take into account when going into looking at a stock to buy the stock versus the option, the entry implied volatility is absolutely key. And I'm going to do some separate videos on just how important that is. I'll sort of go through and analyze how some people made 100x on Tesla, but you really need to have a very cheap implied volatility. If you're going to pay up for implied volatility, like people do with GameStop, it just changes things a bit. You have to do it at very certain times. I think after major sort of market sell-offs like the COVID in 2020, and be buying much further away out of the money. This trade that I did here was sort of an intermittent low. So to buy it way out of the money was actually just too dangerous. But buying way out of the money when the market in general has had a huge sell-off is, I'm not sure if safe is the right word, but the more correct strategy. Coming out of an intermittent low, this is a mark mean of anything, is that it would just sell more aggressively into strength and not wait for things to sort of roll back over and start giving back profits. I need to do a much better job at that. I sort of probably waited too long here. After it sort of failed, it's definitely after it failed, it's huge earnings numbers and got sloppy then. And that was the time to say this is probably stage 3. Time to get out. Again, coming out of a major correction, I can afford to have much longer time frames. With these intermittents, probably a few months is going to be about it. We've already touched on this one. So for stock, DocuSign did this in a big way last year, I think it was, as did Fast and a bunch of others, that if the stock can't sort of power along after good earnings, then there's really no real reason to be there. And again, I'll sort of touch on this. This just suits my personality. I think if say if you bought the stock, made good profits, sell that, take the profits, and not necessarily reinvest a whole lot into options going into earnings, but it just gives you that exposure there. And even if that implied volatility is a bit high, you've already got the profits in the bank. So I think you can afford to, pay up a little bit there. Anyway, that's it.